This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So, our matching rules, therefore, when dealing with disposals of shares by companies. Like with individuals, though, again, like with individuals, unlikely to feature within a question, we would match a disposal firstly with any other shares in that company acquired on the same day. That one, once we've got rid of it, we then look at if there were any, and much more likely as a possibility now for an exam, any shares acquired in the previous 9 days. If there were any, these are dealt with individually, and we directly match now the proceeds on the sale of these shares with the original cost of those shares. Any more shares sold over and above those acquired in the previous 9 days, we go back and look at the share pool, made up, of course, of any shares acquired more than 9 days previous to now our date of disposal. Like with individuals, the share pool records both the number of shares bought and or sold and the cost of those shares, as we said, for each acquisition and disposal. But we also have to deal with the fact that for companies in corporate tax, we get indexation allowance. Companies, as we know, are entitled to indexation allowance. So whenever shares are purchased or sold, whenever shares are purchased or sold, we've got to do a re-indexation of the index cost of the shares in the pool. So every time we buy more shares, or eventually when we sell shares, we've got to bring that index cost column up to date by re-indexing the previous figure of index cost through to the date of this subsequent transaction, be it another acquisition or be it now and eventually a disposal. We'll see how we carry out this very mechanical process in a moment's time. Any indexation, any re-indexation we now compute, would be added to the index cost total, which is recorded in a separate index cost column. So we're now going to run 3 columns in this share pool: number of shares, cost of shares, and index cost. When calculating the indexation allowance at each purchase or sale date, we now have the one time where we abandon our normal rule of indexation, which was to round an indexation factor to the nearest third decimal place. Now the indexation factor is not rounded. This makes it even easier. You just leave the result of your calculation, the RPI now less what the RPI was, either when you bought or at the last date of re-indexation, and take that increase in the RPI over the original RPI at the last time of re-indexation. And instead of taking your calculator, looking to the third decimal place and rounding to the nearest third decimal place, you just leave it in your calculator and just multiply out by the previous balance on your index cost column. Now, to show you how to do this, because it will be vaguely meaningless at this point just in words, we've got our example 2 to show not just how the share pool is constructed, but also, of course, how we deal with a disposal of any shares that we may have acquired in our history of share ownership on a particular company. So let's have a little look therefore. There we go. Example 2. Calculate the gain to include in the corporate tax computation for our year ended March 17. The important information: A Limited sold 3,000 shares in October 16, at which date, month, we had an RPI of 264.8 and our proceeds were £36,000. We now want to see where those 3,000 shares came from. So we had bought the shares in what appears to be B Limited here. In August 89, we have the RPI. 1,000 shares were purchased at a cost of £5,000. November 96, we bought another 2,000 shares at a cost of £12,000. 7th of October 16, you'll now note I'm being very precise because this sale was the 10th of October 16. So this 500 shares that were bought at a cost of £5,000, we can now see, well, they weren't purchased on the same day as the sale took place, but they certainly were purchased within the previous 9 days of that sale. Therefore, in terms of our identification rules, there will be no shares acquired on the same day that are now sold, but there will be 500 shares that were acquired within the previous 9 days that are now sold. We know specifically what their cost is, £5,000, and all we need to do is to apportion those proceeds. We have got 500 of these 3,000 shares now sold, being attributable to this acquisition here on October 16. Then, as we've obviously sold 3,000, not just 500, we'll go to our share pool, and those two purchases, August 89 and November 96, it is they that will be allocated to that share pool. Right, let's just show our determination, therefore, of the gains on this disposal. One, in relation to the share disposal, there was no acquisition on same day. Secondly, there were 500 shares acquired in the previous 9 days. So that for us is the first calculation now to be done. Okay, let's just give ourselves a wee bit more room. Sales proceeds. Now we know that we are specifically dealing with 500 of the 3,000 shares that were sold for proceeds of £36,000. That therefore now would give us sales proceeds on the 500, 1/6, 500 over 3,000, of £36,000 will, I think, be £6,000. What was the allowable cost? The allowable cost, we were told, £5,000. Now, where we have this identification of shares acquired within the previous 9 days, there is no indexation allowance. So your chargeable gain is here, the 1,000. Now, it's pretty obvious here, because both the disposal and the acquisition were within the same month, October of 2016 there. But even if it had overlapped from one month to the other, even if there had been a presumably quite small change in the RPI, it's ignored. There is no indexation there when dealing with shares disposed of that were acquired within the previous 9 days. However, when then we move thirdly to our share pool, and for which of course we'll need rather more working space, then there will be within the share pool indexation allowance. It's the one thing that changes from the share pool that we dealt with for individuals. So let's now put together, for this third point of identification, the share pool. Now, like we had with individuals, we will run a column to record the number of shares, either acquired or subsequently disposed of. We will then have a cost column, and finally, the new component here, an index cost column. And we kick it all off, this share pool, with our original acquisition. So we had on the 20th of August, when was that? 20th of August 89, an acquisition. How many shares were acquired? We had bought in August 89 1,000 shares at a cost of £5,000. And that cost obviously goes to the cost column, and it also goes to the index cost column. So anything that goes to the cost column also goes to the index cost column. What we'll also then do as we move on to the next acquisition is to re-index that cost every time we buy or eventually sell some shares. So 20th of August 89, 1,000 shares bought, cost 5,000, put the 5,000 in both the cost and the index cost column. We then come through to our next relevant date, which was the 16th of November, and that was in 1996. And the first thing that we do is to re-index this index cost figure. How do we do that? Well, like we always do in terms of our indexations, we want the RPI now at the point that we are indexing. So in November 96, what was the RPI? We're told in the question, I think there from my copy, 153.9. Minus what was the RPI back on that original acquisition date when that £5,000 cost was incurred. That was 115.8. All over 115.8. And this time we said it's so much easier. Don't bother rounding that from your calculator. Leave the result in your calculator and multiply out by this index cost figure here. That was £5,000. Now, multiply that through your calculator. Do check my figures, please. But I got that to be £1,645. £1,645. So in which case, we've now increased the index cost column to £6,645. So whenever you deal either with the purchase, you buy more shares, or as we'll move to in a moment's time, when you sell shares, the first thing that you do is re-index from either, if this is the first re-indexation, from the date of the original acquisition of the original shares in that company, or then on any subsequent re-indexation, you re-index from the last time indexation occurred on the share pool through to the current date. Right. Once we've dealt with that re-indexation, as we have there, we then add in the effects of that acquisition. So the acquisition was of how many shares in November 96? We bought a further 2,000 shares at a cost of £12,000, and anything going in the cost column also goes in the index cost column. So what do we now have at that date, November 96? At that point, we owned 3,000 shares that had cost £17,000, and at that date had an index cost of £18,645. £18,645. Now, that was the last of the acquisitions that went to the share pool. As we know, there was another acquisition, but it was within the 7 days of the date of disposal, and hence we have separately dealt with the gain computed on that specific acquisition. So for us now, the next relevant date is the disposal date of the 10th of October of 2016, where again at this date, the first thing that we do is to re-index. The figure that we're re-indexing is that index cost total at the last time of any re-indexation. What RPIs do we want now? The current RPI at the date of disposal, 264.8, minus, well, you don't even have to look to your RPIs, just look back to the last calculation that you did there, and the last time you re-indexed was to an RPI of 153.9. It is therefore from that you now re-index again. So all over 153.9. Leave it in the calculator and multiply by, as we've said here, this index cost total. That was £18,645. Again, calculator time. Work it through, and hopefully we'll agree then that that comes to £13,400. £436. Add that onto your index cost column, and that should give you, again, all being well, £32,081. So at this date, but prior to the disposal, we now know that we had in this share pool 3,000 shares that cost £17,000 and which have an index cost figure of £32,081. How many of those are now sold? Well, we were selling 3,000 shares, but of which we have already dealt with 500 of those shares that were sold. We've dealt with 500. So the remaining part of the disposal here, coming from the share pool, must be the remaining 2,500. Now, how do we deal with a disposal? It's a pool. So we take out, on an average basis, the share of both the cost and the index cost that belongs to these 2,500 shares. So in relation to the cost, 2,500 out of 3,000 shares multiplied by a cost of £17,000. That cost of £17,000, therefore, multiplied through how much of that belongs to the 2,500 shares now sold. Now, all being well, but again, do please check, I made that a figure of £14,167. 2.5 of the 3,000 shares sold, that had a cost of £17,000, 14,167 belongs to this 2,500 shares. You now do the equivalent calculation of your index cost, 2,500 over 3,000 times, there's your figure, 32,081. Multiply that through your calculator, and again, please do check, but I made that 26,734 worth of index cost to now come out of this share pool. And that means you can now get your revised balances. That would be 500 shares still within the share pool, having taken 14,167 away from 17,000. That would leave you with £2,803, £833, I should say, of share cost. And when we take out the index cost of 26,734 from the 32,081, then the 500 shares that remain would have an index cost of 5,347. But the really important information here is what goes with the 2,500 shares sold, because it's now that disposal that we now need to compute the chargeable gain on. So into our gains calculation, we have got, right, let's just move this down. Now, having worked out that figure to close off at this point anyway, your share pool prior to the next transaction, we can now deal with our gains calculation. Do remember that the share pool does not compute the gain for you. What it gives you is the amount of, firstly, cost, and now in corporate tax also indexation allowance, to be used in this, the gains calculation. So our sales proceeds. We're selling 2,500 out of 3,000 shares from this share pool times 36,000. So we were selling 3,000 shares, 500 we've specifically dealt with for the acquisition within the previous 9 days. That leaves the remaining 2,500 shares of the 3,000 shares sold belonging to the share pool. The total was sold for 36, so 2.5 over 3,000 times that will be proceeds of £30,000. Cost, you know the cost. That's what this was all about, your share pool. The cost, 14,167. Take that away, and that will leave us with £15,833, from which we will then deduct our indexation allowance. Right, this is why we dealt with the share pool in the way that we did, that we've got an index cost figure, 26,734, belonging to this 2,500 shares, and a cost figure, as we've just seen, of 14,167. So what's the difference between the cost and the index cost? Well, it must very obviously be the indexation allowance. So the indexation allowance, 26,734, there the figure from your index cost column, minus your cost figure of 14,167. Take one from the other, leaving you with an indexation allowance of £12,567. Take it away, we have therefore got our chargeable gain of £3,266. So there's your calculation of the gain. Proceeds, less cost, less indexation allowance. Now what you might be thinking is, I can shortcut that working, because I know that the proceeds are £30,000 and I know that my index cost from here is 26,734, and if I take that index cost away, that will leave me with 3,266. And that is absolutely fine when answering a multiple choice question. But if you're dealing with a written question, then show it this full way. Show it the proper way, with both cost and indexation allowance being identified. The reason being is that we know that any indexation allowance cannot serve to increase or create a loss. So if that total had been more than your proceeds of 30,000, your index cost had been more than 30,000, then you couldn't show a loss just by deducting, imagine that was 36,734. You couldn't say that therefore I've got a loss of 6,734. What you'd have had to have done was to deduct the cost to give you an unindexed gain. If that figure was a loss, that would be your loss figure. But all the indexation could then do in this calculation here is to bring you down to nil as the lowest figure you could have. Indexation cannot serve to either increase or create a loss. So if answering a written question, okay, it takes you a few seconds longer, but show the cost figure and then show separately the indexation allowance. If you're doing a multiple choice question, just use the index cost figure, if, of course, that as a total is less than your sales proceeds, and it can go directly to your chargeable gain. Thank you very much. Job done, therefore. Okay, take a moment now just to pause and then check through, please, with the answer at the back, and make sure that you are happy with how we got those gains. The total amount of gains, of course, arising at this point as regards the disposal, you dispose, remember, of 3,000 shares, is this gain, 3,266, plus where we started, where we identified the specific acquisition, and that was, again, there, make sure I've got the right one. Oh, of course, that was back on, I beg your pardon, that was back here, the £1,000 there. We put it back on the question page, hadn't we? So the two combined together, £1,000 here, and out of your share pool, £3,266, then the total gain made on the disposal of the full 3,000 shares sold will be £4,266. Check it out, please, with your answer in the back, and then come back and join us, where we'll look at, as we did with individuals, the other ways by which we might acquire shares in a company, other than going out and buying from some shares from an existing shareholder. Okay, well, of course, as we know, the two ways by which shares might be acquired directly from the company rather than going and purchasing from a third-party existing shareholder is through either a bonus issue by the company or a rights issue. Now, remember what they are. With a bonus issue, of course, that all that happened was you received more shares from the company. There was no cost, you didn't pay for that, it was just the company reorganising the capital section of its balance sheet there. So what happens with a bonus issue? It will increase the number of shares held with no corresponding increase in cost. No increase in cost. There isn't any cost. The bonus shares, therefore, are simply added to the number of shares column in the pool, and because there is no cost, do not index the cost of the original shares to the date of the bonus, as no new cost is incurred. Now, what will happen is that no doubt at the date of the bonus issue, an RPI will be provided by the examiner. As the old saying goes, they give you sufficient rope by which to hang yourself here. We do not. There is no reindexation of a share pool through to the date of a bonus issue, because with a bonus issue there is no change in that cost. All you then got to remember to do when you move on to either a subsequent and further acquisition or the eventual disposal, remember you need to reindex from the last time that you reindexed, and that will not be the date of the bonus issue. With rights issues, well, again, you are now acquiring more shares based on your existing shareholding in the company. But this time, there is a cost. This time, the company is going to its existing shareholders as the first port of call in raising additional equity capital by saying, "Ooh, have we got a deal for you? For every however many shares you already own the company, you can buy this one extra share for whatever is now our marvellous discounted offer price." So you can then choose to either take advantage of that or not, to buy or not. If we do buy, then it's just dealt with like any other purchase. So a rights issue, again, will increase the number of shares held, but this time, because there is also a cost associated with the share acquisition, it is therefore dealt with in the same way as any other acquisition. The index cost in the pool, index through to the date of the disposal, the date of the rights issue. So we reindex like we would on any other purchase when we buy shares. The right shares then are added to the number of shares column and to the cost column, and of course the index cost column as well, just like any other acquisition. The only problem we face is computing how many shares are acquired under the terms of the rights issue, which again will not be difficult. 1 for 2, 1 for 3, 1 for whatever number, or 2 shares for every 5 shares held, or whatever number. Just multiply it through, get your acquisition. So here in example 3, we have got a little bonus issue exercise. Calculate the gain on the disposed of the shares in October 16. What are we told? Y Limited sold 2,000 shares in October 16 for £12,000. So we need to know how and where were they acquired. We originally acquired 3,000 shares in X Limited here on the 20th of July 93 for £10,000. February 95, X Limited made a 1 for 3 bonus issue, a bonus issue here. So in which case the last acquisition was February 95 prior to the disposal in October 2016. So the first thing, if it's a written question that we're dealing with, we can write that there are no shares that were acquired either on the same day or within the previous 9 days. There were no shares acquired on the same day as the sale, nor within the previous 9 days of that sale. Therefore, there is one working to do, and that is the share pool. So we now put together our working of the share pool. And as ever, we need number of shares, cost of shares, and an index cost column as well. So what have we got? 20th of July 93. 20th of July 93, we have our acquisition. We then purchased, what was it? 3,000 shares, and the 3,000 shares cost £10,000. Stick it in the cost column, stick it in the index cost column. £10,000. The next relevant date was February 95. That was, no, it was February 95, sorry, I beg your pardon. February 95, let me look at the wrong thing. February 95, where there was the bonus issue. So, February 95, oh, don't think I've got a specific date in February, so February 95. Now, normally, on a subsequent acquisition, you'd be re-indexing. But that is only when you purchase shares. Here, you're not purchasing. You are acquiring, yeah, but it is a bonus issue. There is no cost involved, hence it's easy. There is no re-indexation to do. And all you've got to do is to show the effect of that bonus issue. The bonus issue was 1 share for every 3 shares held. Well, that's simple, 3,000 shares, so 1,000 shares without any change in your cost or index cost. So we've now got 4,000 shares, still deemed to have cost 10,000 with an index cost of 10,000. We then move on to the next relevant date. Now, that could have been a further purchase, acquisition of shares, but for us it was the disposal date in October 2016. So we come through to October 2016. This is a disposal, so the first thing that we do is to re-index. How do we re-index? What is the RPI now at the date of disposal? It is 264.8 minus what was the RPI either at the date of the last re-indexation, there wasn't any, therefore at the date of the original acquisition. What was that original date? July 93. What was the RPI then? We are told 140.7. So take that all over 140.7. No rounding to 3 decimal places, times what was the figure on your index cost column? £10,000, and bring it up to date. Put it through your calculator. I made that a figure of £8,820 to now add in to your index cost column, thus giving you £18,820. We've still got 4,000 shares at this point of disposal with a cost of £10,000. We've now got all the information we need to be able to deal with this disposal from the share pool. How many shares are being sold out of this pool? What was the disposal there? We sold 2,000 shares. So, of the 4,000 shares, 2,000 shares are sold. We take with those 2,000 shares, we're selling 2 out of 4, so 2,000 out of 4,000. Obviously, this is a half of both the cost figure, 10,000, and then the index cost figure of £18,820. So half the cost, 5,000, half the index cost, 9,000, and what's that? £410. There's the information that you need to go with this sale of 2,000 shares, which we can now put into a separate gains calculation. Now, that therefore would mean that we are selling for, where's our proceeds? We are selling for £12,000. So we're going to have to go on to a blank page here to fit this in. So we have got sales proceeds. We sold these shares for £12,000. They're all from the share pool. Nothing on the same day, nothing in the previous 9 days. They're all from the share pool. What was the cost figure we've just taken from that share pool? £5,000 unindexed gain 7,000. Take out our indexation allowance. Our index cost that we were taking out was 9,410. The cost figure 5,000. Therefore, £4,410 will be the extent of the indexation allowance. Take it away, and that will leave us with £2,590 worth of chargeable gain. Again, if it's just an objective testing question, we can go straight to that figure simply by deducting the index cost of 9,410, those two combined, away from your 12,000, less the 9,410 there, and that will be your 2,590. Job quickly and easily done. Okay, hopefully therefore we are now okay with dealing with a bonus issue. What we will look at in our next session together is how to deal with the rights issue, which, as we've already discussed, they're back in our questions, as we've already discussed, is simply dealt with like any other purchase. But have a little look through now the answer, if you need to, in the back for this example 3. Have a little read through again the note for your rights issue, and then we'll deal with that next time. The only other thing that we'll need to do with next time, just as we did for individuals, is then also to look at takeovers. We will look at takeovers as well there. Okay, so again, take a little break, as it were, and come back and join us again in our next lecture together.